Welcome back to the Money Under the Mattress podcast. My name is Mitchell and my co-host is Jake. And today we are joined by Francisco Olivera. Francisco graduated from Bentley University and is now the co-founder and president of Arevilo Capital Management, where he runs a highly concentrated portfolio. Others have quoted him as the Munger of media. Some of his holdings are Charter Communication, Liberty Broadband, as well as Disney. We're excited to talk to him today and learn more about who he is, as well as discuss his strategy and holdings. So thank you for coming on today with us, Francisco.
Hey, Mitch and Jake, happy to be here. I can't claim to be I think that was a joke started by Greenwald and others rallied behind it, but definitely would never refer to myself as the bugger of media.
Yeah, I saw Greenwald tweeted that the other day, so I was like, I'll put that into the intro. So I guess we'll go with our first question here is, how did you get started in investing, moreover like value investing?
Sure. I'm from my dad's side of the family, my father and my grandfather were involved in investing, and my dad, who's my mentor, when I was in high school, gave me Joel Greenblatt's book, The Little Book That Beats the Market. Very simple, short read, high level philosophy on investing. And I think that spurred huge curiosity and interest from my part, and kind of drove me to study finance in college and soak up anything I could read about Warren Buffett and other investors, and that kind of started me on a trail that to eventually after I graduated from Bentley, which was a great university, and to give a background in finance, and they have a trading room that students can work in and work on projects and have real world kind of simulations in finance. And that was a huge kind of a educational backbone, and went to do investment banking afterwards in JP Morgan for a couple of years, and had an opportunity to, I'm from San Juan, Puerto Rico, moved back home and had an opportunity to start Arevilo Capital Fund. And yeah, with family and then friends and friends of friends, and off we went. So yeah, that's a little bit of the Spark Notes summary of my background and how I got started in investing.
Yeah, it's awesome to hear. How do you go, Jake?
Yeah, so next question we got is, how has your investment strategy evolved over time? And have you always had this long-term outlook?
Yeah, I think it's natural for any investor's strategy, thoughts, philosophy to evolve over time. And I think basically when I started investing, when you start learning about companies and the markets, basically see the world a little bit in a simple lens, because you're just starting to learn about things, how companies are valued, why stocks move the way they do. So I started reading value investing books, and you basically think, well, I buy something at a low PE ratio, call it a PE ratio of 10, sell it at 15, and it's easy. But obviously things are a little bit more nuanced, right? Something that could be appear to trade at a low valuation might be actually at a high valuation, and vice versa. So I think learning about Buffett early always had that long-term mentality, but my long-term mentality has evolved from, hey, maybe being patient to get a valuation read rate, so the 10 PE to the 15 PE, towards an orientation of long-term to see how a business actually evolves, and be patient with the business and let the business perform for you, and that'll translate into the stock price. So over time, you learn about different companies, you learn about different industries, you make mistakes, so you decide to avoid certain situations. And little by little, I think everybody, takes experience and different nuggets and evolves, right? There's certain type of investments that I'm a more concentrated investor, but sometimes you realize, well, certain companies you wouldn't want to concentrate too much. Others could be a lot, a bigger percentage of the portfolio, a lot easier. So there's not like one thing of how it evolved, But just taking all those things together, learning about different companies, feeling more comfortable and knowledgeable about certain industries, and then having a lot of respect for the markets. I think you might read a value investing book for the first time, and unfortunately, many people think, well, it's easy, right? But it's really not, and we all learn, markets are inefficient, but they are inefficient at times, but they're usually roughly right. So you have to have respect for the markets. Just so all those things together is how I think one evolves, and I think it's natural for someone to evolve as an investor over time. If you're not evolving as an investor, you're probably not being curious enough or intellectually honest. Because if you maintain a strict kind of philosophy or guideline or rule book to investing, I think you're probably are going to stumble in all likelihood. So always try to evolve.
Yeah, totally agree. How long have you been investing for?
So personally, I would say late high school, kind of early college. But Arevilo Capital Fund started in mid 2014.
Okay.
So in a more of a professional way since mid 2014, but personally in my own personal accounts and reading and basically experimenting in the early days since probably around 2007, 2006, in that range.
And back when you started, did you start with value investing, doing fundamental analysis and that likes?
Yes, definitely. So, but I would say maybe I led more with fundamental kind of valuation multiple type of analysis versus thinking about business. Today, if somebody tells me, it could be a friend, it could be someone on Twitter, it could be a fellow fund manager, hey, have you thought about this company? I will not think about a ratio off the top of my head. I will not think about kind of a P ratio, free cash flow multiple, sales multiple, enterprise value, EBITDA, nothing like that. I'll think about the business, right? And what I think about the company and what the company does, how the services or products they sell to customers or other businesses. And that'll inform my view of how I think the company will perform over the next 5 years after doing more work on the company. And I think once you lead with that type of work, I think you'll feel more comfortable and more confident in the type of multiple evaluation that you pay for the company. So I think in the early days, you're reading value investing books, you're saying, well, like this trades at X thing, and I wasn't thinking necessarily about, how the product could evolve in 5 years, how the competition could evolve in 5 years plus. And today I'm more leading with that. So yeah.
True. Like, I mean, when you're reading a majority of value investing books that I've read so far, I might have read maybe a dozen or so. They don't really talk. Yeah, they don't talk about competition. They don't talk really much about the actual business itself. It's more based on price to book, PE, price to sales. What you were saying, like EBITDA. So,
yeah, because I mean that's an expression of many things, right? So sometimes it might be actually a bad sign that a company is trading at such a low multiple because the market's not going to give you a, just to exaggerate, a 50% free cash flow yield in a very strong company that's growing, that's better than its competitors, that's returning capital and has reinvesting opportunities. So right, there's not a free lunch that like in like that really. You might be able to figure out something that in 7 years is yielding something very, very strong on a free cash flow basis. But that they're not gonna, it's not gonna appear necessarily in the LTM last 12 months type of numbers. So I think that's what I'm trying to look for, and the things how I've also have changed over time. But the answer much of the time is, well, hey, look at this company. Well, I might not know anything about it, right? So it also takes time, right? And it takes a lot of time to understand an industry and a company, right? You can read the 10K and have a good idea, but that's kind of a point in time, or basically recent couple years. And sometimes you could see, well, the company's margins might be down over the past 1 or 2 years. And at the top of your head, you're like, well, that's, it's a bad sign. Why are margins going down? But actually, it could be a good sign. Maybe the company is taking down margins because they're investing in a new product that's going to actually create huge margin boost in 5 years. So sometimes you need much more context about a company. That it takes hours of dedication. Now the key is to figure out what situations are worth dedicating kind of like weeks, months worth of work versus basically just reading a business description about a company and saying like, I don't think I'll be able to ever figure it out. So I think that's when the circle of competence framework comes in here. And I think it's always important to keep building a circle of competence, but no one's born with a circle of competence, right? You have to build it.
Mm-hmm.
So that takes time. And over the past 5 years, there's industries that I understand better today than I did then. But that's why curiosity is very important here, because it takes time to learn these things.
True.
So you go, Mitch.
All right. So when you're analyzing a business, do you ever jump out of the annual reports and the quarterly reports and do some type of scuttlebutt? So like on the ground type work on these businesses, or are you mostly behind financial statements and just anything that you can find on the business online?
Yeah, it depends. I mean, in terms of like, talking to management, talking to competitors, talking to kind of like supplier type of dynamics, I think that deeply, sometimes, but if you get a hold of management and some companies, that'll come with certain biases.
Mm-hmm.
There are services that offer like expert type interviews, and I think those are important. But I think those are sometimes framed in a way that are very biased. So you got to know the company very well. I think what's important is that once you're done with, understanding what a business does and understanding kind of the 10K and the financial statements and why they're moving in the way they are, the numbers, why they're moving the way they are, because it's very important not to just look like a balance sheet and an income statement and just look at ratios. You have to understand like why is something very, very simple. Like, why is debt going up? Why is debt going down? Why are margins moving the way they are? Why are sales going up a lot? Is it an acquisition? Is it some service that's growing fairly quickly? These are very simple questions, but it's very important to understand kind of the movement, right? If you understand why a business that has 20% EBIT margin today is going to realistically have 30% EBIT margins in 5 years, that is a game changer, right? Especially if sales are growing, which I assume they are in that scenario. That's a game changer for the company. And if you understand that or are confident in that, and you're not paying a high price, I think that's usually important. But to your question, I think once you have the 10K down and understand the company down, it's important to, and it's an industry that a company that you have a big investment in, it's concentrated and it's long term. It's really important to think like kind of like an industry insider. So what are people that work like executives in this company are reading about on a daily basis? So like trade periodicals, right? So if you're a cable company executive, you're probably reading like Fierce Cable, Fierce Wireless, which are trade publications, multi-channel news, those types of of publications that are like writing every day about the industry. How are things changing at the local level? How executives that are moving around, if there's something with the FCC, the Federal Communications Commission, there's some news out of that coming out that's important to the industry. So just thinking like, because the SEC filings, the big SEC filings, there's like 4 times a year, 1 time a year, and then the conference calls and the Wall Street conferences that sometimes these executives participate in. Those are basically a handful of documents and events a year. But being in the daily kind of like, what are these people reading and looking for in the industry that's publicly available, of course. I think if you do that with certain industries, certain companies over time, you're going to have an informed view of and tying that in with 10K and financial performance of how the industry is moving, right? And which players are the stronger players and how things should evolve. So tying that in terms of like kind of scuttlebutt type of research, yes, you always want to, to the extent like, if you're able to get in touch with somebody who worked in the industry, or who is in an industry that's adjacent to the company, so if you're able to, someone who, if it's like a business that basically sells to other businesses, and you can talk to a business that's a customer, right? Because if it's not a consumer facing business, I think if it's a consumer facing business, it's important to understand the product yourself from a consumer perspective, right? So like if you're investing in like a fashion industry, right, or high-end fashion or merchandise, it's important to understand how a real customer thinks about that. And you yourself might not be that ideal customer, but you got to get in their frame of mind, and that takes time. So like if you want to invest in a watch company and you don't even wear a watch, right? Well, you have to get in that mentality, because if you won't understand, like you might talk to a friend who actually collects watches, like, well, this company's crap, man. They haven't released a good watch in like 10 years. They don't even age well. They don't appreciate. So you have to think like that, like a customer, like an industry insider. And I think that's what's important, and that takes time. And someone can read a 10K, be blown away. By the way, management teams do manipulate 10Ks, not the numbers, right? But kind of the wording, right? So, if they can make, the management discussion seem much more positive, they will, right? I'm not insinuating companies like, kind of do large scale fraud or anything like that, but you're basically reading a document the management team prepares with the help of their lawyers. Yeah. So that's how I try to think about things, and to get my own kind of viewpoint about a company or industry.
So I'm looking at your portfolio right now, and there's one common theme, and it's a lot of media companies. So what has attracted you so much to the media industry?
I think a couple of things. It's evolved over time. Invested in reinsurance, home builders, fast food, tech, different type of industries. But I think many of the media entertainment businesses are consumer facing, consumer touching. Many of them have attractive margins, have an attractive profile to grow, generate a lot of free cash flow. So it's not one thing per se. A lot of it started with my interest in Liberty Media, and I think this was in the 2013, 2014 timeframe. Liberty Media Corporation basically had a bunch of assets together. Had Sirius XM, a stake in Charter Communications, the Atlanta Braves, a big minority stake in I might have said it already, but Live Nation. And so it is a lot of different assets together, and they actually many of these stakes are also publicly traded. And at one point they tried to acquire the remaining stake that they didn't own in SiriusXM, which is another public company that they controlled. And I came from kind of the investment banking world, so I try to pay attention to deals and things like that, and sometimes there are special situation type of opportunities. So when you have this kind of weird entity that has consolidated businesses, controlled companies, investment stakes, and tries to fully acquire another business that's public, it was a little bit intriguing. And as I dug into Liberty Media, learned about the cable business and Charter and their investment, learned about SiriusXM and their investments, learned about the business of sports. They own the Atlanta Braves. Learned about the live entertainment concert business, the other stake in Live Nation. Had a sense of their philosophy of why did they end up with these investments, what's their role with these companies, why did they want to fully consolidate SiriusXM. They ended up not purchasing the rest of SiriusXM. SiriusXM is still a public company, and Liberty Media controls nearly 80% of it. But eventually they broke up these entities and they spun off their stake in Charter Communication. They created 3 tracking stocks where they put the Atlanta Braves in one. They put their Live Nation stake in another one, and that ended up buying Formula One. So that I learned about Formula One. And then they put the SiriusXM stake in another entity. Eventually they swapped, a little bit of a rant here, but they swapped the Live Nation stake from the Formula One entity to the SiriusXM entity. But that's how I really got my start in learning about all these media and entertainment companies. And it kind of shows how like curiosity can take you to different directions, right? So just learning about this deal that Liberty Media tried to acquire SiriusXM led me to learn about cable companies because they own a stake in Charter, and learning about Charter led me to learn about Comcast, led me to learn about Altice USA, another cable company. Learning about Live Nation taught me about the live entertainment industry and to look at the music business more closely. Learning beyond the Atlanta Braves gave me an informed view of sports teams and their valuations. There's a couple of sports teams that trade publicly. And learning about Formula One, which they later purchased in 2017, taught me about a global sport and how it's run and how they manage sponsorship, television contracts, and how they divide the revenues with the teams and how they manage promoters. So and even you can take that further and learning about kind of content companies led me to interesting opportunities with Fox and Disney. And Disney's getting into streaming, so you learn about Netflix, and then you learn about Netflix and can take what's Netflix doing, where are they heading. There's a lot of talk about Netflix getting into video gaming that leads me to video gaming. So it's always important to kind of stay curious and stay, because one company can lead you to another, and then it can connect you with different industries. Because nowadays, especially in the consumer facing front, basically you can connect Amazon to almost any company in the world nowadays. Not quite exactly, but almost. And even Apple, and Google and Microsoft. So learning about one company can lead you to another, and just following a trail and staying curious. So I think it's a long answer to why I'm interested in the media and entertainment space, but it really started with putting the pieces together of the Liberty Media puzzle, because there's a billion tickers for all the John Malone related entities, but just curiosity and learning about businesses that I think I could understand from a consumer perspective, and generate and has attributes that I think are strong businesses for the long term. I don't think every if you look back and you purchase kind of a Viacom stock, which they own Paramount, CBS currently. You pick that stock like 6-7 years ago versus, a Comcast, you would have vastly underperformed. So I think it's an industry that you got to get the right players right, and not necessarily one that that'll lift all boats, right? If it's performing well. But
Yeah.
But I think it's a fertile ground and lots of activity as well, because there's a lot of disruption, and disruption creates a lot of consolidation as well. And I think consolidation, if structured appropriately, can create a lot of opportunities.
That's super interesting how it all branched from almost the one idea of Liberty Broadband, and Liberty Broadband went from Charter with as well as Comcast and Altice USA, and then from as well as Formula One too, I guess, and then from those that branched into the streaming, which was Netflix, Walt Disney. So it's super interesting. I've never really heard that before. When we're talking to other investors, usually then they'll kind of say, I'll be interested in, for an example, I'll go into technology knowing nothing, and I'll just try to learn as much as I can. And then I'll try to go and learn, I don't know, I'll go try to learn grocery chains. And so it's kind of interesting, just the fact that I've never heard that before. So
yeah, I think what's important, at least for me, right? I think there's people, and I've met many of them, who can do very deep work on any industry, and it doesn't matter. They'll dig in. They'll be fairly accurate in terms of like the drivers. I'm more driven by interest and I think, because you have to, at the end of the day, look, like everything we've talked about, it's a lot of work, right? To have an informed view about a company and industry evaluation, it takes time. And if you're not interested in what you're learning about, I think it's hard to be engaged. So I think the way I found is, sometimes it can be like a friend, like Alex Morris or Bill Brewster or my dad. Hey, have you looked at this company? I'll look at it, right? And that might lead me down to a trail. But I also think it's important, like, hey, if I'm studying this company, then thinking about other companies that are related to that, and sometimes that'll lead you to something else. And maybe the initial investment you were studying wasn't the one that you end up making. Maybe it's a competitor, maybe it's adjacent industry. So you always kind of keep digging and searching. And it's investing is, like, I think people have said before, it's like a never ending puzzle, right? You never put the final piece together. You're always putting pieces. So I think that's, some of these documents, public companies can be dense, or conference calls or things like that. So I think having a true interest in wanting to learn, I think that's what's driven me. So when I touch on companies or how that they're all connected, I think that's what has driven me in a sense. But it's not how everybody does it. There's no perfect way in investing, I think.
No, I mean, I found that out myself too. Is just sometimes I'll be reading. Usually, my first document I read is a 10K on a business if somebody has said something about it to me, saying you should check it out. So I'll read the first couple of pages of a 10K, and if I'm not interested in it, then I most likely will kind of throw it away, just on the fact that if I'm not interested, I won't do enough deep dive. Like, I won't go as deep as I should into it. And then that just puts up enough risk on my end.
I think what's important. Yeah, I think what's important is differentiate something that you could be very, very interested in from something that, you can be very interested in it, but it doesn't mean it has to be a good investment, right? So I think that's also what's important. Because at times I've done deep work on companies that I'm super interested in, and actually I think are good companies, but they might not be the best investment. But the good thing is that you don't have to invest, and that knowledge accumulates, and maybe down the road there's some random correction, or there's a quarter where the business underperforms below expectations for some reason, and the market vomits it, and then you have kind of like a clear perspective from having followed it. So I think that's what's also good about it. But yeah, I think interest is a huge driver of pushing curiosity. I think, and curiosity is essential.
I guess we'll go into one of your holdings that you were telling us beforehand that you just recently sold. I believe it was 5% was the position. Was that in Comcast?
Yeah, so Comcast sold recently. It's an investment that had for a couple of years, for I think approximately 4 years, and it's a couple of things. It's the majority, the vast majority, I think, roughly 70-ish% is driven by the cable company. That is, the heart of that is the broadband business in the United States, and that's a phenomenal business. It's dominant, high free cash flow, defensible profits, strong against competitors, growing penetration. It benefited from the pandemic, right? Everyone's locked down at home, working from home. Well, you need reliable, high speed internet, and it has other aspects of it as well. It owns NBC Universal, which has a portfolio of cable channels, a huge um, film studio, Universal, obviously, and has movies like Fast and the Furious and Jurassic World that dominate, do very well in the box office. Has a big television studio as well, big animation studios like DreamWorks and Illumination. So think Minions, Secret Life of Pets, Boss Baby, and Boss Baby 2, which was just released this past weekend. And they have a big pay TV business, primarily satellite, but evolved to being streaming business in Europe called Sky, and their main markets are in the UK, Germany, and Italy. And the I think it's a business that is protected against the downside, given the backbone is a broadband business, and I think that business is going to generate meaningful cash flow going forward. But the media business, and by that I mean the more kind of entertainment business that was dominated from the pay TV bundle in the United States, and television shows and programming and movies released there and in theaters, that business is evolving and being disrupted very, very quickly. Obviously Netflix has been the biggest drivers of that. They have, because Netflix offers a simple monthly subscription, uh, reasonably low priced, especially compared to the pay TV bundle, with unlimited movies and television shows and catalog and global. And they've created a phenomenal business and has no advertising, and that's disrupted everybody. And I think if you are a content creator, this is more the NBC Universal side and the Sky side, content creator, programmer, you really have to be thinking about how do you position yourself to be, a very strong player in 5-10 years. And then I look at what Disney has done. This full disclosure, we own Disney, and Disney basically said, like, look, we can't live. We're not going to be able to survive if we depend from the pay TV bundle forever. If we license all our content to Netflix, yes, we'll receive a lot of money, but then Netflix will gain leverage over us. So we have to take control of our future. So they did some acquisitions in order to bolster their streaming technology and content offering. They launched Disney Plus. They took it globally. They had different strategies in different markets, but a strategy of, like, we want to be a ginormous global player and have scale, right? And what I saw from Comcast is that, yes, they launched a streaming service in the United States called Peacock. they didn't have the amount of content needed really to make that a huge service beyond kind of like the broadband and pay TV customers. They weren't in it to really all in, because you can look at these companies' financial statements and you see how much content they license in Netflix and others. And they still license a lot of content. And what you basically have to do is disrupt those licensing fees, take that content, put it in your own service, and invest a lot of money on that service, not only with technology, marketing, acquiring customers, but also in a lot more content. So you have to disrupt the royalty fees that you're getting from licensing content. In addition, investing in more content and in tech and all these things. So it's a huge free cash flow burn. I mean, you look at what Netflix has been burning free cash flow for many years, but now they have a ginormous business. Disney's kind of gone through that exercise, and they're going through that exercise, but they're being successful. They have over 100 million subscribers globally, and they've disrupted their licensing fees, invested in the tech, invested in the content. They have very powerful brands and strong library. And what I see Comcast doing is kind of a halfway thing. Like, we're still licensing, but we have our service. It's really domestic. We're not really taking it global. You've seen them experiment a little bit more. So they released Boss Baby 2 in theaters this weekend, and they put a date with the Peacock service. So if you subscribe to Peacock, we were able to see Boss Baby 2 over the weekend, which my kids actually saw. The first one was better. But the point is that they're still not thinking, they're still not being really ambitious about this business, which just tells me they're more focused on preserving profits, very, very good profits that they have from the NBC Universal business. And I think being in that halfway dance is going to hurt them, and they're going to wake up one day and be like, well, actually, we just either should have really invested in this business, or we just should have licensed all this content to Netflix. Which, licensing your content to Netflix is not the worst strategy, as long as you create content that's good enough that Netflix or another streaming player like an Amazon or an Apple are willing to pay up money for it. So you take another company like Sony, has a very good film studio and television studio, and they're part of a larger conglomerate, right? But they've largely taken the strategy of like, hey, we're just going to license everything to Netflix, and they're going to pay up because we make pretty darn good content. And you know what? That's a pretty good strategy. It's a lot of free cash flow, high margin that they're going to receive. But if you're in this halfway dance, investing a little bit in the streaming service, investing a little bit in licensing, you got to think about these companies as a culture and being driven by a North Star. And I think that's real. And if your employees and everyone's driving in one direction, and you're really going after a huge opportunity, I think people get motivated and want to work with you and for you. So Comcast is in that halfway dance, which I'm not sure really kind of what the grander vision for the company is, because in all honesty, the broadband business no longer has real synergies with the European pay TV business, the domestic broadband business with the European pay TV business, or the content business, the NBC Universal business. So in reality, should either break up the business and run the cable company like a Charter that's a standalone cable business and stock that's done very well because it's grown, its return capital to shareholders has been focused on growing the broadband business and customers and customer penetration and expanding actually their homes passed. So I think Comcast could benefit from breaking up the business, but if they don't, which is fine, it's basically controlled by Brian Roberts and his family. If they want to keep it together, then maybe be more ambitious and invest serious money in becoming a more global streaming powerhouse, which I think the opportunity is there for them, but they haven't really moved in that direction. And I think honestly the clock is ticking, and now you see Apple putting serious money, Amazon, now they want to buy MGM, and they're putting way more money. They're much more serious. Netflix obviously has ginormous scale, and and continue to be the place to go for to sell content, and really where consumers are watching the most streaming video, outside of YouTube type of content. And Disney obviously has had their North Star, and they're being very successful. So I think Comcast is in this halfway dance, and if you're in that halfway dance, then the broadband profits are going to go to finance that halfway dance, and there's going to be cash flow that is basically burned up and not really returned for shareholders or put in a productive use for long-term shareholder gains. So it was, I run a concentrated portfolio. You have, handful of holdings, and, you have opportunity cost, and you have the stake, and, I've owned it for a long time, but I'm seeing how the landscape is changing, and there's other investing opportunities. And look, I think Comcast has low downside if for some reason the stock falls a lot. I know the business well, so I could judge, definitely would not ever rule out investing again. But all these things together, and it's a stock that's not expensive at all. All these things together, I think that's basically why I decided to sell. And there was a recent, after I saw, I think it was an article in the Wall Street Journal, I think it was last week, talking about how they view themselves and this consolidating landscape. You see that Discovery and Warner Media had merged, and now they want to create another global powerhouse in streaming. So the industry is moving in a direction, and I'm not sure they're skating fast enough in that direction. And it's like if you're playing, the industry used to play water polo in a pool that's 3 feet deep, and now it's 20 feet deep, right? And not everyone's going to survive at that level. And I feel like that's what's really happened in the video entertainment business, and that's where I'm a little bit kind of more concerned about for them. But on the other hand, they generate a lot of cash flow in broadband. They're not going anywhere. Their parks business is pretty darn good. They have great content assets that I think a Netflix would love. If Netflix could buy DreamWorks, Illumination, and Universal, piecemeal from Comcast, I think they would do it in a heartbeat. Especially because Netflix wants more intellectual property. So it's a great business, but yeah, that's a long-winded answer of why I sold. If I had a 30 stock portfolio, it'd probably still be there. But yeah.
So you already kind of touched on how you generate your ideas, but is there any other sources you use, like a Value Investors Club write-ups or anything like that?
Yeah, I mean, I try to read everything that I see of interest. Benefit from a great group of friends, like Alex and Bill I mentioned earlier, and Twitter. Honestly, Twitter's an amazing resource. So yeah, I think ideas can come anywhere, right? You can read a Wall Street Journal article that leads you down a path. If you followed an industry for a while, you can sort of see something pop up. Occasionally go on kind of message boards and value investing clubs, and somebody will, over time you build a network, and somebody might think you have an interesting perspective of something. So I always try to share things with other fellow investors, and hopefully they share things with me, and there's a back and forth. There's not a perfect way to find a good idea. But yeah, I think Twitter is a great resource. I think podcasts are increasingly becoming a very good resource. If you're learning about an industry, you could probably find a podcast about people discussing the industry on a weekly basis. So recently got interested in the video gaming industry, and there's a bunch of good podcasts of just people discussing not video games themselves, but the business of video games. This is not an industry where I invest. in, but like you can go on Spotify and search for like oil and gas podcasts, and there's a bunch of them. There's like oil and gas tech podcasts, there's oil and gas kind of like, you know, industry discussion. So I think things like that are good resources. You just kind of like stay on top of, and maybe there's a, you know, podcast show that discusses different companies and things, and you know, not necessarily going to listen to every episode, but if you see something that pops up, you know, in different substacks, and I think, you know, Alex Morris has a great substack. He has a podcast too, but his substack, you know, it's discussing companies that he's thinking about analyzing, investing in. There's a couple of those. Andrew Walker does great work, and has a free Substack and a paid Substack and a podcast. And I think his podcast, he interviews different people pitching different stocks. Those are always interesting.
He's on yet another value channel or value podcast, correct?
Yeah, that's his.
Yeah.
Yet
Okay.
another value blog and podcast. So very, very smart person, and does good work. So yeah, you just kind of keep your, you know, eyes open, and you know, because the good ideas it can come from anywhere, man. It can come from like you walk in a shopping mall and kind of seeing something that kind of piques your interest and leads you down a trail. So yeah, there's no like one way to find a good idea. Maybe reading an investor's shareholder letter. So there's a lot of good hedge funds and mutual funds that put out letters that are good reads.
I guess going back to the Comcast sale, I'm not sure if you're allowed to answer this question or not, so I guess bear with me.
Sure.
With your 5%, like it was 5% of the holdings on April 5th. I'm not sure what it is now or what it was on the sale. With that sale, did you put that money just straight to cash, or did you put it back into a business that you already own?
Yeah, sure. So some of it went to cash. Some of it went to kind of other businesses that I've owned and wanted to add more of. In March, Roblox went public via a direct listing, and so that was a new position as well, and became a little bit more meaningful position, and so I'll use some of that cash as well. There wasn't like one main use of the cash.
Okay.
But yeah, the I've completely sold a lot of Comcast though.
Okay. In your holdings, what is your favorite business that you own? If you have one.
You know, I think they're all different, right? I think the largest investment in the portfolio is Charter, and really a combination of Charter and Liberty Broadband, because Liberty Broadband is essentially a holding company that whose the majority of its value is an investment in Charter. Mm-hmm. So I consider Liberty Broadband to just owning Charter. So Charter is a business I've owned for over 6 years, and it's pure play cable company driven by the broadband business. Significant free cash flow and free cash flow growth and free cash flow per share growth because they repurchase a lot of stock. I think it's a business that's very defensible. So the broadband business typically doesn't have many competitors in their markets. And it's a business that if a competitor is going to come into their market, they have to put significant capital and marketing dollars to work. And if Charter knows that a competitor is coming to their markets, they can invest more in their business to make it unattractive for the competitor to come in. So it could be a fiber competitor and a cable overbuilder. It's a business where, 6 years ago, the industry was in a path to consolidate more. It's an industry that majority of the revenues were from the pay TV space, and people looked at it like, well, cable TV, it's going away. The margins are declining. huge tailwinds, and that's all true. But what was underappreciated was the power of the broadband business, and there still is, a significant portion of the U.S. that's on DSL, low speed internet, and cable was disrupting that, and they were also going after the small business sector. So it's the biggest holding because held it for a long time. Now, thankfully, the stock has done well, but it's a very defensible business and that is still has a path to grow free cash flow meaningfully. They basically they take their free cash flow and repurchase shares. If they could do more M&A, they would, but it's not real at the moment. There really hasn't been like a huge meaningful cable acquisition that they could do, but it's defensible. So I see it as low downside, a stream of profits that you can basically bank on to be sustainable and grow over a long period of time, and it's going to return a lot of capital to shareholders. So usually the bigger the investment is, kind of the lower the downside I think it is. But it also has, pretty meaningful upside by growing its free cash flow over many years. So I think this is the biggest holding. It's been the biggest holding for many years, but it's really a great business. It's an amazing management team led by Tom Rutledge. I think last year signed another contract to extend for 4 more years. When Charter went bankrupt in 2009 during the financial crisis, it essentially was a small cable business that Paul Allen of Microsoft fame kind of rolled up a bunch of cable businesses and levered them significantly, and that entity went bankrupt, and you had folks like Apollo and Oaktree take over the debt, converted into equity, took the company public again. They hired Tom Rutledge, who came from Cablevision, and before that was at Time Warner Cable. And he aggressively invested in the business, took capital expenditure as a percentage of revenue really high, because the business given the leverage, given the bankruptcy, there was a lot of neglected investment. So he really made the cable system a lot better. Created a pricing and packaging strategy that was attractive for customers and reduced churn significantly. But then, the private equity folks, they need to give the money back to their investors, right? So they eventually need to sell their equity stake. That's where John Malone and Liberty Media came in and basically bought approximately a quarter of the business, and took board seats, and Greg Maffei, John Malone, they brought in a vision of consolidation. And this is a great business, but it should consolidate. And there's a bunch of drama that we can do in 1 hour plus podcast on. But eventually they bought Time Warner Cable and another cable business called Bright House Networks, and did the same strategy of investing in the business, integrating all these cable systems, growing free cash flow, reducing customer churn, improving broadband speeds, improving penetration, taking market share. And basically the business has grown free cash flow extremely well. They've maintained leverage at a constant rate. So if you're growing your operating income and you maintain your leverage, right? Your leverage multiple, you're essentially, taking free cash flow and taking incremental debt and just returning it back to shareholders. And that's what they did. So it's a simple levered buyback strategy complemented with great business execution, just led to enormous shareholder returns. And I think we still have a good path going forward to have strong business and performance and generate even further shareholder returns. It started as a before I invested in it was a turnaround play post bankruptcy, but then consolidation play, and now it's just they're executing at a very high level, and we'll see. There's probably more M&A to be done, and there's always been lingering risks. So I think when I started investing in the cable business, well, like, hey, pay TV is not that good, and you're gonna have Google Fiber come in and disrupt your business. Well, Google Fiber, I think Ruth Porat came in into Google, now Alphabet, and basically said, like, look, we can't spend all this money on fiber capex if cable's going to beat us, right? It's just throwing away cash. So that business has retreated a little bit. Now there's been a lot of talk about 5G, but 5G is a little bit more complicated too in terms of how it can really disrupt cable. And then, cable business have all, I've been forward looking as well. They Comcast and Charter have a resale agreement with Verizon, and so now they're in the wireless space, and they bundle broadband with wireless, and they've grown nicely from there. I think Charter is nicely over 2 million customers in that business. Pathway to get millions and millions of more customers in the wireless business, and when bundled with broadband, it's going to reduce churn. So it's a business that's constantly been able to kind of fight fears and competitors and do well. And yeah, it's a great management team, ownership mentality, and so yeah, it's basically a little rant there of why it's a business that I like a lot.
Yeah. So when I was watching your investor presentation, you had mentioned that Charter Communications would be buying back a lot of their shares, and since Liberty owns a certain amount, what is it? Is it 23%? Is it?
Liberty Broadband owns, I think it's 26%. They have an ownership cap. So before they had less, but Charter has bought back, and their ownership has increased. But when they got to the cap, now Liberty Broadband essentially participates in Charter's buybacks. So what Liberty Broadband does is that they participate pro rata on the buybacks, and then they repurchase their own shares. So
I was just going to say that I found that pretty interesting when you had mentioned that in your investor presentation.
So yeah, I mean, Liberty Broadband, I'm not sure what the exact discount is today, but I think it's around 20% discount actually to Charter. So it's a very meaningful discount. There's various reasons why it's that big, but there's no way it should be that big. So they participate in the Charter share repurchase, and then they're able to sell relatively tax efficiently. I think they pay kind of like a 5% of proceeds, more or less, maybe a little bit more. So there is some tax kind of like leakage, what they call. But the net amount, even though it's 5%, so 95% of that, you repurchase your own shares that are at 20% discount. They're still, fairly accretive. I think if they do that consistently, and all indications are that they will do that consistently, then the Liberty Broadband discount to Charter should tighten. And I think over time, those two entities will probably merge, and maybe they merge at like a 3% discount or a small discount, because obviously, Charter needs an incentive to buy Liberty Broadband.
Yeah.
And I think you have like an extra layer of margin of safety there of owning Charter via Liberty Broadband, a big discount, and eventually a discount I think will close.
Interesting. How do you structure your portfolio? Like when you make an initial investment, like what type of bet are you making percentage wise, or is there no really distinct allocation? It all depends on the business.
It depends on the business. What I do have as a framework is that, if I'm not going to make it a 5% investment, at least, it's probably a business I don't really want to own. There's going to be certain situations where it's very small because some weird skewing upside downside, but just generally for the 99.99% of investments, like if I don't want to commit like 5% of the portfolio to it, it's probably a pass. Mm-hmm. And honestly, it I challenge myself sometimes to, well, like, more than 5%, it shouldn't be in the portfolio. It's not going to be 7 or nearly 10. So I think right now we have about eight investments or so, and so it's very concentrated. And I think it's a good exercise that when you analyze something, well, I basically have to sell something else, right? So not only does it got to get through that, like, do I want to commit and take the risk of 5% or more of the portfolio, but do I like it more than something else that I own? And I think having that competition, right, in your head when you're analyzing different opportunities is a good thing. So there's no kind of perfect perfect formula to it. If it's a business that I think has, very low downside as a business, not as a kind of like volatility in the stock, but if I think the business is very, very likely to be as strong or stronger going forward, I think that's when you say, well, you should probably commit, more to it. And obviously its valuation is attractive as well, but if it's a business that is a newcomer, subject to a lot of change, potential disruption, you probably shouldn't make it your biggest investment, right? If it's something like, from my point of view, it's something like Charter, it's very real estate like, recurring subscription revenue, kind of like almost like a monthly rent, a high margin profit rental income, right? That's growing and they're returning a lot of that back. That's has low downside and probably merits, if the valuation is good, to be a big investment. If it's something, something that's not generating cash flow today, there's nothing wrong with that. But they have to execute on a lot of different things to generate a lot of free cash flow down the road. And that's where you have to kind of battle how big you want the investment to make. And there's no right or wrong answer. Sometimes, like, you have to be very, confident in your analysis, and you should make it a bigger investment, even though, like, potentially doesn't have cash flow today, but it could have huge free cash flow relative to the stock price in 7 years, right? So, there's a lot of subjectivity involved in this. I don't think there's I don't think my way is perfect or anybody's way is perfect, but I think it's what has kind of worked for me, at least.
Do you have a cap, like how much you would put in?
Not specifically. I think at cost. So, like, initially, right? I think probably the most I've ever put in is probably like 15%. It's rare occasions, but usually it's gonna be in that kind of 10% range, plus or minus.
Okay. Would you like to talk a little bit more in detail about Arevilo capital management?
Sure.
I'm just wondering, like, how is it structured? Is it structured similar to like a Buffett partnership?
Oh, yeah. So exactly, it's structured very similar to the Buffett partnership. No management fee, 6% annual and cumulative hurdle, and whatever's above the hurdle, it's 25% profit interest. Okay. So I think it's very friendly. Like, if the returns are like 0% for a year, the following year you got to recover the prior year 6%, 6% in the current year, and then you can participate in the profit interest. So I think it's a very fair structure to partners, but rewarding if I do a good job.
True. Yeah.
Had you ever considered like separately managed, or was it just always partnership?
I like kind of having the partnership structure, a group of people investing in one strategy. I think there's a lot of pros and cons to the separately managed, but it kind of just having kind of like one entity kind of like attracted to me more, maybe simpler kind of. I know that today there's different software that kind of makes it almost the same running separate managed accounts, but I kind of wanted that feeling of like we're all in an entity together versus like catering to each person with a certain strategy, if that makes sense. But I mean, there's no right or wrong way.
No, me and Jake were just curious because eventually, hopefully, me and Jake would like to start a partnership. And so I was wondering how people structure their partnerships. And that's, I believe, what we will do is do the 0625, 0 off the top, 6% hurdle rate, and then 25% of profits.
Yeah, I
After
think
6.
I think it's very fair. I think it's a very fair structure. I think it puts pressure on the manager to get good returns. It's fair on the investor, right? You want to see some sort of return before you really give a meaningful profit pool to the investment manager. So I think it's the way to go. I mean, in terms of like structuring, whether it's managed accounts or anything like that, I think it's really what's more comfortable to you. Honestly, I don't know if there's a right away, as long as you do well by your clients and investors. Like there's many ways to skin the cat and do well by clients.
If theoretically, if yields were to rise, would you raise that 6% par?
I don't think so. I mean, they would have to rise a lot, I think, right? I think where's the 10-year 1.4, or did it dip below 1.4? So I mean, I think the 10 years at like 10%, I think or the 2-year, right? Because we're talking about short-term kind of risk-free type of return. I think the philosophy behind Buffett at the time is that I think is because 6% was kind of like the risk-free kind of shortish return yield. So I think we're far away from that type of world currently, and I think it's kind of I think it's kind of stuck around. People copied it, and 6%. It's still meaningful, kind of a kind of first return before there's a carry. But yeah, I mean, if it's we're in a bizarre interest rate environment, would never be opposed to kind of changing it. But I think we're far away from that. I think. I mean, nobody can predict interest rates or markets, but yeah.
Sweet. Well, where can listeners find more about you?
Yeah, I mean, I think Twitter is the best way. At Franco Olivera on Twitter, and my email is folivera@arevilocapital.com as well. Happy to chat with anybody about investing, exchange ideas. But yeah, this was a lot of fun, guys.
Perfect. Yeah, well, we'll put those 2 links down below on our bio there on the podcast for anybody that's looking for it. So thank you very much for coming on with us today there, Francisco.
Thank you very much, Francisco.
We'd like to have you on again during season 2. Maybe you and Alex can come back on. It's been awesome having you.
Thank you so much, guys.
Thank you very much. Thank you for listening to this episode of Money Under the Mattress. If you have any questions about this episode, you can email us at moneyunderthemattress.podcast@gmail.com. Everything discussed in this podcast is our opinion and should not be used as investment advice. This podcast is for entertainment and education purposes only, and hope you enjoyed it.